You work for it. You earn it. You deposit it into a bank. And at that exact moment, without a sound, without a warning, your money stops being yours. Not stolen, not hacked, not frozen. Legally, deliberately, by design. Most people believe a bank is a vault, a safe place where money is stored and protected, a modern version of a locked box. But that belief is the first illusion. Because what if I told you that when you deposit money into a bank, you are not storing it, you are giving it away? What if the system you trust with your savings doesn't actually owe you your money, but only a promise? And what if that promise has already failed? Multiple times, in multiple countries, to millions of people? Tonight, we are going to trace the hidden history behind modern banking. Not rumors, not conspiracy, but law, policy, and precedent. By the end of this video, you'll understand why your bank account balance is not ownership, it's a claim, and why the moment you deposit money, control quietly changes hands, setting the stage, the illusion of safety. To understand how this happened, we need to start with a simple question. What do people think a bank does? Ask almost anyone and they'll say, banks store money. That idea feels logical. Banks have vaults. They have security. They have locks thicker than prison doors. But modern banks are not vaults. They are financial intermediaries. They don't hold your money for safekeeping. They use it. And this wasn't always obvious, because the system evolved slowly, quietly, and intentionally. To see how your money stopped being yours, we need to go back to the origins of banking itself. Their origins, when money was actually stored. In ancient civilizations, money storage was simple. Goldsmiths, merchants, temples. People deposited gold and silver for protection, and received a receipt, a claim ticket for the exact same metal. The relationship was clear. You owned the gold. The keeper guarded it. The receipt represented your property. If the keeper used your gold without permission, it was theft. Ownership never changed. But something subtle began to shift. Goldsmiths noticed that depositors rarely came back all at once. Most gold just sat there. So they made a dangerous decision. They began lending out deposited gold, while still issuing receipts for it. Two people now believed they owned the same gold. That decision created the foundation of modern banking. The rise, fractional reserve banking is born. Over time, this practice evolved into what we now call fractional reserve banking. Here's how it works. When you deposit $1,000 into a bank, the bank does not keep $1,000 in reserve. It keeps a fraction, sometimes as low as 0 to 10%, and lends the rest. That same money is loaned, deposited again, and loaned again. One deposit becomes $1,000, then $9,000, then $90,000, then millions, all created from a single original deposit. Your money didn't disappear, but it multiplied into obligations. And here's the critical detail most people never hear. The moment you deposit money, ownership transfers to the bank. Legally, you are no longer the owner. You become a creditor. The bank owes you money, but it is not required to keep your money. This isn't opinion. It's written into banking law across most of the world. The legal shift, ownership quietly changes. In legal terms, a bank deposit is a loan. You loan your money to the bank. The bank can use it however it chooses, within regulations. In return, you receive an IOU, a promise of repayment, access to numbers on a screen. Those numbers represent claims, not property. This distinction matters, especially during crisis, because when a system collapses, owners have priority, creditors wait, and sometimes, creditors get nothing. The breaking point, when promises fail. History has tested this system repeatedly, and every time stress hits the system, the same pattern emerges. Let's look at what happens when too many people ask for their money back. Banks don't have it, not because of fraud, but because the system was never designed to allow it. This is called a bank run. And when it happens, governments step in. Fallout, bailouts, freezes, and confiscations. In 2008, global financial markets collapsed. Banks had lent out far more than they could cover. Assets evaporated. Trust disappeared. What happened next revealed the truth. Banks were rescued. Depositors were restricted. Governments injected trillions. But here's the part rarely discussed. In several countries, depositors were legally sacrificed. In Cyprus, 2013, bank accounts were frozen. Depositors lost up to 47% of their balances. This was called a bail-in. Not theft. Not emergency seizure. Legal policy. Depositors paid for bank failure. Why? Because legally, the money wasn't theirs anymore. Failed fixes, insurance and false comfort. After repeated crises, governments introduced deposit insurance. In the US, it's the FDIC. In other countries, similar schemes exist. These programs promise to protect deposits up to a limit. But here's the uncomfortable truth. Deposit insurance does not mean money is safe. It means losses are socialized. Insurance funds are tiny compared to total deposits. They rely on future taxes, money creation, political decisions. If a systemic collapse occurs, insurance becomes a promise, not a guarantee. Once again, numbers on a screen depend on trust. Modern parallels, the same pattern repeating. Today, the system is larger than ever. Global debt exceeds $300 trillion. Bank leverage is higher. Digital money moves faster. And the illusion feels stronger. But the structure is unchanged. Banks still lend deposits, create money through credit, operate on fractional reserves. And depositors are still creditors. During recent bank failures, withdrawals were limited. Transfers were delayed. Emergency measures were imposed. Not because of criminal activity, but because the system requires control during stress. Digital banking makes this easier. No lines, no vaults, just buttons. And buttons can be disabled. The shocking data, why this matters now. Here's what most people don't realize. Less than 5% of modern money exists physically. Over 95% is digital credit. Banks depend entirely on confidence. When confidence breaks, control replaces access. And legally, depositors stand behind institutions. This isn't dystopian fiction. It's precedent. Cause and effect. Why the system was built this way. Why did this happen? Because fractional banking fuels growth. It expands credit, funds governments, drives economies. But it also concentrates risk. And when risk materializes, the system protects itself first. Not maliciously, systemically. 3 clear takeaways. 1. A bank account is not ownership. Your balance represents a promise, not possession. You are a creditor, not a holder. 2. Stability depends on trust, not reserves. The system works as long as confidence remains. When it breaks, access changes instantly. 3. History shows who pays first. In every major banking crisis, depositors absorb losses, directly or indirectly. Warning, the question nobody asks. The system doesn't fail often. But when it does, it fails fast. The question isn't, will banks collapse tomorrow? The question is, **, do you understand the rules of?